The four most dangerous words in investing are "this time it's different." Funny thing is, the people who say those words are usually wrong. But sometimes, the people waiting for history to repeat itself are wrong too. Because the next housing crash won't look like 2008. And that's exactly what makes it dangerous.
Imagine spending 15 years preparing for a hurricane, boarding up your windows, stocking canned food, building a bunker, and then a wildfire shows up instead. That's basically where we are with housing. Ever since 2008, Americans have been obsessed with one question: when will housing crash again? But what if we're looking for the wrong crash? What if the real risk isn't collapsing home prices, but something much stranger? Because today, the housing market looks nothing like it did in 2008. Different buyers, different loans, different incentives, different villains. And yet, millions of Americans still feel locked out. Prices remain near record highs, mortgage payments have exploded, and housing affordability is sitting near some of the worst levels in modern history.
To understand today's housing market, we need to revisit the original disaster. Back in 2006, America had too many houses, too many bad loans, and too many people buying homes they couldn't afford. Banks were handing out mortgages like free samples at Costco. No income? No problem. No job? No problem. No pulse? We'll have to check with underwriting. By 2008, nearly 10 million homeowners would eventually lose their homes through foreclosure. Home prices nationally fell roughly 27%. Some cities got absolutely demolished. Las Vegas, Phoenix, Miami, entire neighborhoods looked abandoned. The problem was simple: too much supply, too much debt, too many weak borrowers. But today's market has the opposite problem, and that's where things get weird. Let's meet the villain. It's not subprime mortgages, it's not mortgage fraud, it's not Wall Street packaging toxic loans. It's supply, or more accurately, the lack of it. According to estimates from Freddie Mac, America is short roughly 3.7 million homes. Think about that. We're missing the equivalent of several major cities. And then came 2020. The Federal Reserve dropped interest rates to near zero. Money printer go burr. 30-year mortgage rates fell below 3%. At one point, Americans could borrow money cheaper than inflation itself. Housing demand exploded. Home prices nationally surged over 40% from early 2020 through 2022. In some markets, it was even crazier. Meanwhile, builders couldn't keep up. Labor shortages, material shortages, zoning restrictions, higher costs. Supply stayed constrained. Then, the Fed slammed on the brakes. Mortgage rates jumped from around 3% to over 7%. One of the fastest increases in modern history. And this created a bizarre new problem. Millions of homeowners are now trapped. Why? Because nearly 80% of mortgage holders have rates below 5%. A huge share have rates below 4%. Think about it. If your mortgage is 3%, why would you sell your house and buy another one at 7%? You wouldn't. Most people wouldn't. So inventory stays locked up, and the market freezes. Not because nobody wants houses, because nobody wants to leave theirs.
This is where the story gets interesting, because housing today resembles a bad dating app. Buyers are swiping, sellers are swiping, nobody is matching. Existing home sales have fallen to levels rarely seen over the past few decades, yet prices remain stubbornly high. Normally, higher rates should crush prices, but limited inventory is acting like a shock absorber. This is why so many people feel confused. They keep hearing higher rates will crash housing, yet prices haven't collapsed nationally. The reason is simple. In 2008, supply flooded the market. Today, supply is restricted. The mechanics are completely different. That doesn't mean there are no risks. Far from it. Commercial real estate faces pressure. Certain overheated markets remain vulnerable. Investors who bought at peak prices may struggle. And if unemployment rises significantly, forced selling could increase. But the biggest risk may not be a dramatic crash. It may be years of stagnation, a housing market that goes nowhere, prices drifting sideways, affordability staying terrible, first-time buyers remaining locked out, a slow motion problem instead of a sudden disaster. And those can be even harder to solve, because nobody notices them until years later.
History doesn't repeat, it rhymes. The housing market of 2026 isn't the housing market of 2008. Back then, the danger came from too many houses and too much debt. Today, the danger comes from too few houses and a market frozen in place. Could prices fall? Absolutely. Could certain cities experience major declines? Of course. But if you're waiting for a carbon copy of 2008, you may spend years watching the wrong movie. The future is uncertain. Always has been. Always will be. The goal isn't predicting every twist. The goal is surviving them. Because in investing, the winners aren't usually the people who predict the future. They're the people who prepare for multiple futures. And right now, that's a lesson worth remembering.
The goal isn't predicting the future. It's understanding the forces shaping it. If you enjoyed this breakdown, subscribe. And I'll see you in the next one.